Home Depot disappointed with its earnings last week. Sales were relatively flat, missing Wall Street's estimates, and the company also forecasted a drop in profits for 2023. The company cited a few reasons for this miss. First was lumber costs. Lumber prices surged last year, but are now down around 50% from a year ago. Second, wages. Home Depot will spend $1 billion in wage increases for its employees, which will have a negative impact on its margins. And finally, the economy. The CEO, Ted Decker, pointed out that people are spending more on services like travel and dining and experiences, and less on goods, in this case, home improvement products. Home Depot shares fell 7% after the call and ended that day with one of the biggest declines out of all of the S&P 500 stocks. Scott, what are your thoughts here?
My thoughts are what's bad for Home Depot shareholders is good for the world. And that is, there's this incredibly powerful force in the universe, and that is reversion to the mean. And that is, luck is almost perfectly symmetrical. And that is, if you have a great luck around investment, that means you're due for bad luck and you should pull in your horns. When you have bad luck, I think that's the time to be most aggressive because it means you're due for good luck. And what I've just been blown away by is how the majority of trends have reverted to where they would have been had there been no pandemic. So if you look at e-commerce, if you just took the growth rate of e-commerce in 2019 and took it out another 3 years, you see this huge spike up, but then it's come down and it's exactly where it would have been on its own. And what we're seeing here is vicious reversion to the mean around the amount of money people are spending on their homes. When people were stuck in their homes 24/7, they decided we need to upgrade, we need to renovate. And all of a sudden it's like, no, revenge travel. The last thing I want to do is be in my home. I experienced this at Section 4. We had this massive growth in 20 and 21 in online education. And then towards the end of 22, we couldn't get arrested because the last thing anybody wanted to do was be stuck in their house, staring at a screen, learning about brand strategy. And the business is probably where it would have been had we just kept growing the way we were growing pre-pandemic. And what we're also seeing is stocks like Restoration Hardware that were darlings and zoomed to 750 have now come back because people are like, I overinvested in my home. My home's been pretty severely upgraded. And I'm going to invest more on going to Thailand or taking my family on a cruise for the first time, or I'm going to go, I'm going to finally go somewhere where I don't have to show my vaccination card. So this is healthy regression to the mean or reversion to the mean. And the other thing I really like about this is that frontline workers in retail are getting a raise. And I like that. I think it's hugely overdue. These individuals are kind of on the front lines. And if you ever see an organization putting its workers in commercials, that means they're underpaying them. When they start calling them heroes, that means management thinks they're fucking idiots. Anyone you call a hero, our teachers are our heroes. That means we're underpaying them. You don't need to be called a hero if you're paying someone a fair wage. They're fine not to be called a hero. And so when you see these big retailers talking about the strength, the McDonald's cashier, they all get together and read how he's gotten a scholarship. I'm like, well, isn't that cute? But maybe you should just pay him or her 14 or 15 bucks an hour so they can afford their own college, or think of not, which they couldn't do on that wage. But I find this is a good thing that we're seeing. The strongest part of wage growth is at the front line and the lower income level. And it is so overdue. So Home Depot, I like the stock going down here because it's a function of some healthy trends. One, young people and people getting out of their house, and two, frontline workers and retail employees making more money.
Yeah, it's so funny. When I was scripting the headlines here, I had written that Jason, our editor-in-chief, pointed out to me that I had basically parroted the PR department's language about these wage increases, because I had written that Home Depot is investing $1 billion into the wage increases of its employees, when in reality, Jason was pointing out, it's like, no, it's just increased labor costs. Like, they have to do that. But the way that it wasn't
their idea.
Yeah, exactly.
Wasn't their idea.
Yeah. But just going back to the economy. So US existing home sales, we just had some data come out. Existing home sales dropped for the 12th straight month just now. and it's at its lowest level in more than 12 years. And you've been describing that, people aren't investing in their homes as much, and we're going to see revenge travel. How long do you see this lasting? I mean, Home Depot is forecasting a massive drop in their profits basically for the entire year. Do you think that that's an overprojection? Or do you think that eventually we're going to, we're sort of at peak revenge travel and we're going to come back down and see more investment in home improvement and people buying homes more than they are now?
They're two separate issues. One is what you do with your discretionary income. Do you upgrade your house or do you go to Thailand? And we had a lot of the former through the pandemic. Now we have a lot of the latter. As it relates to home ownership, there was some very disturbing data that came out last week, and that is 1 in 3 houses nationally are purchased all cash, meaning the rich are ballers. Think about 1 in 3 houses. I think over half the houses in Naples, Florida were purchased for all cash. And at the same time, first-time home buyers have hit a record low, meaning young people can't afford homes, but older rich people can now pay cash. So this directly goes to income inequality and incumbents and advantage being ceded to old people at the expense of young people. We have a housing crisis because of this NIMBYist bullshit culture we have. It is so difficult to develop. And that is, once I have a home, I'm going to endorse and show up to the local architectural review board. And I mean, I'm not exaggerating. We bought a piece of property in Delray. We're planning to develop on it. And someone showed up to the local review board meeting and said, well, I like to walk my dog over there. And I'm like, okay, that's called trespassing. And they decided to delay the approvals 3 months to talk about where there's other places this lady can take her dog to shit and pee over my property. And so, but the local boards have incentives. They all own homes, and everyone who shows up to the meeting owns a home. The people who don't show up to the meeting are young people who want to move there who can't afford a home. They don't show up and say, hey, I'm thinking about buying a home in Delray. Is there any way you could make it like not unaffordable for me by having more housing stock? We have a crisis of too few freshman seats at colleges, and we have a crisis where it's hard for small companies to emerge past the big guys, and it all comes down to the same thing. The incumbents have weaponized government to their advantage. Once you have a home, a college degree, or a business, you don't want new entrants, and we need legislation that basically ensures the law errs on the side of growth and new entrants, and that always gets people's hair on fire. What you're seeing in the housing market is more of a psychological phenomenon. That's in addition to just the raw economics where young people can't afford it. You're seeing the economic impact of higher interest rates. So the affordability, if you make, I don't know, $2,000 or $3,000 a month, or you can pay $2,000 or $3,000 a month for a mortgage, it's gone from you can afford $750,000 home to $500,000 home. So that just takes down, that's just a gut punch to the housing market. In addition, what we're seeing is this psychological impact of what I call just a standoff. And the standoff is the following. A couple who own a home think, okay, the Joneses 14 months ago got $700,000 for their home. That must mean my house is worth $720,000. And they ignore the data that as interest rates have gone up and housing prices have come down, no, your house is probably worth $550,000. They refuse to believe that. People always anchor off the high point. And meanwhile, the buyers are reading all this data and think they're going to come in and swoop in and buy something on the cheap. And what there hasn't been yet is there hasn't been capitulation or price discovery. And that is, I was looking for a home in Colorado. I love it there. I've seen the inventories build dramatically, but there's nothing trading hands. Because again, the sellers are still want to believe that it's early 2022 or late 21, and the buyers want a crash. The buyers think a crash has happened, and it's somewhere in between. But I would bet in 2 to 3 quarters, you're going to start to see capitulation. People need to move, the death, divorce, disease, whatever it is, and you'll see stuff get repriced. But this is just right now, it's a standoff. The good news is housing prices need to come down. Young people need to be able to afford homes. So I'm hoping that home prices do come down substantially. Now, if you bought a home in the last 2 years, that's going to be bad for you. There's always pain, but there's just no getting around it. A great means of saving is to own a home. It's a point of pride for people, and young people can afford them. So I'd like to see housing prices come way down.
Well, here's a tiny little piece of good news. Biden is cutting mortgage insurance costs for new home buyers insured by the Federal Housing Administration. It's only cuts costs by $800 a year. That's 0.3%. But it's something, and perhaps it'll slightly move the needle on this housing issue.